Chapter 4, Choosing a Form of Business Ownership. So let's look at some of the most common forms of business ownership and examine the pros and cons and when one form might or might not be more appropriate than another form. So to start out, we'll start with the simplest form and the easiest and fastest to set up, which is, of course, a sole proprietorship. And as you can see by the slide, a sole proprietorship is owned by one person, usually operated by that person. And as we said, it's very simple. It's easy to get in, easy to get out. So by virtue of that, it's probably not surprising that by numbers, sole proprietorship is the most common form of ownership in the United States. Not by revenues, but certainly by numbers. And it might surprise you to know that some of the names that you know, like Annie's Homegrown, Kinko's, eBay, all of those started out as sole proprietorship. Now, not surprisingly, as they grew, they adopted other forms that fit a bit better. So let's take a look at some of the advantages and disadvantages. Easy to set up, easy to get out. Retention of all the profits, no special taxes. And by special taxes, we mean that it avoids the double taxation that you get with a C Corp. And I'll talk about that a little bit more in a minute. The downsides, and you'll notice that there are several. There is unlimited liability. Meaning that if, let's say that you've got a little restaurant, somebody slips and falls, they come after you, they can go after you for everything if you get sued. So that is what we mean by unlimited liability. And that's why the corporate form, one of the main reasons that it evolved was to address that, the liability issue. There's a lack of continuity, meaning that if the owner dies, the business also faces a demise. Challenges with lack of money, lack of management skills, and difficulty in hiring employees. And part of the difficulty of hiring employees is because they know that the business doesn't necessarily have the same continuity that a different form might have. So throughout this discussion of ownership, the issue of limited liability or unlimited liability comes up again and again and again. And it's because it is such a big issue. And especially living in such a litigious society, you cannot afford to not take that into account, to think about some way of protecting yourself. So we'll look at a couple of forms that offer limited liability. And by limited liability, I mean that if you've got $100,000 invested in the business and somebody sues you for $1 million and they win, you're only going to lose that $100,000. With unlimited liability, that's just as the name implies. So that's a major concern with a sole proprietorship. And a couple of class exercises. For now, I'll let you just kind of peruse those and contemplate that, kind of as a self-thought type exercise. And then let's look at partnership. And partnerships, people stereotypically think of that as two people, but it can certainly be a lot more than two. And we'll look at two forms of partnership. So partnership overcomes some of the challenges of a sole proprietorship in that you can bring in different types of talents. Let's say that you're the one that is good at kind of a big idea thinking and a concept. It might be advantageous to bring on a partner to deal with kind of nitty-gritty things, or if they have some sort of specialized talent. It's also helpful in the sense that partners can hopefully bring in some capital. Now, there's two types of partnerships. There's a general partnership, where they're both general partners, and there's a limited partnership in which at least one of the partners is a limited partner. And by limited partner, this means that they are not involved in the day-to-day. They're kind of more of an investor. So the advantage to the limited partner is you might go, well, what do you mean by limited? Well, it limits their liability. So even a quote-unquote limited partnership has to have at least one general partner, and that's the one that assumes full responsibility. But the limited partner does have limited liability. So that may be advantageous depending on the circumstance. So I want to define articles of partnership in that this is the written agreement where you should really spell everything out. And it's really interesting to me. I have a very close friend from way back when who entered into a partnership agreement with a formerly, notice the word formerly, close friend of hers. And they decided to pool their resources and knowledge. And it looked like it would be a beautiful arrangement because they were going to start a magazine. And my friend is a journalist and her former friend is a lawyer. So you'd think, wow, what a match. That sounds great. You can both bring their respective skills to bear. Well, the problem is we're all friends until we're not. So that really makes the point that it's important to spell things out. Because one of the things that they failed to spell out was who gets what portion of the profit. So my friend, being, pretty level-headed person, said, okay, let's split it 50-50. And the lawyer said, I'm a lawyer. How about 70-30? So needless to say, things fell apart pretty quickly. So it's really interesting. If you think about a partnership, and I would encourage you to think of it this way, if you go into business with someone, really think about it as a marriage. And that holds for several reasons, because going into a marriage, surely you've seen people get married. They are just giddy. They're just exalted. It's very exciting. So same thing with a business. People go into that not thinking it's going to end, but frankly, most things in life do end, and that's not necessarily a bad thing. So by virtue of that, in the Articles of Partnership, I would encourage you to spell out a couple things. Can you look at this and tell me what my friend and her former friend failed to spell out? I think it should jump out at you. Okay, a couple of things. They failed to spell out, who gets what, and they failed to think about this. The what if. Where's the exit strategy? What happens when we part company? And also who gets what. If it looks like your would-be partner is balking at that, you can always do the blame the lawyer approach and say, my lawyer is really, really anxious to dot the I's and cross the T's. We need to spell this out just for clarity. So I think it makes it obvious one of the potential disadvantages of a partnership is management disagreement. And then the other is unlimited liability. So either in a general partnership where they've got unlimited liability for everyone, or even in a limited partnership where the general partner still has unlimited liability. Another issue is lack of continuity. And this is where I do encourage you, if you do go into a partnership, there are ways to protect yourself. So back to the marriage analogy, I feel like I'm abusing that. But when people get married, they oftentimes, if they're thinking ahead, they think, well, let's get life insurance because in the event something happens to me, I want to protect my spouse or my kids. With a partnership, you really need to think of that too. To think about protecting your employees or protecting your family in the event that something happens to one of the partners. So you can partially address this part, the lack of continuity thing, because God knows you don't want to find yourself in business with your former or deceased partner spouse. So think about some form of a key man insurance where you buy insurance on each other. So the advantages of a partnership, let's take a look at those, are right here. But there are still some disadvantages. And so an attempt to kind of address some of the major disadvantages resulted in the corporate form. So a corporation is really an artificial person. It's really interesting because they can do a lot of what you and I could do, in that they can buy or sell property, they can sue or be sued, they can enter into contracts just like us. However, in a sense, they're better than us because they live forever. So that's the really interesting thing about a corporation. And just to define a couple of terms, the owners, the people who own pieces of ownership in a corporation, are stockholders. So if you buy stock in Coca-Cola, you have a little tiny bit of ownership in that corporation. And just to go further, Coca-Cola is an open corporation, meaning you and I can buy stock in it. Mars, the maker of your favorite candy, however, is a closed corporation. So unless you were fortunate enough to be born into the Mars family, you cannot buy stock in that corporation. In terms of forming a corporation, it's a lot more nitty-gritty than the two forms we just discussed. So I would strongly encourage you to get some legal counsel here. A couple of other terms. Domestic corporation, I think, is pretty straightforward. Foreign corporation is less because you tend to think foreign is that outside the United States. No, it just means that it's incorporated in another state. So the vast majority of corporations are formed in Delaware just because that's easy. So even if it's a California corporation, if they're incorporated in Delaware, it's called a quote-unquote foreign corporation. And then alien corporation, I'll let you read that, is chartered by a foreign government and conducting business in the U.S. So the articles of incorporation spell out the details, which you see here. There are two types of stock. There are common and preferred. And preferred means that they get paid first before the common stockholders. Distribution of earnings takes the form of a dividend, and you can use a proxy to transfer your voting rights if you're a stockholder. The board of directors are responsible for overseeing the management of a corporation. And I'll let you look at some of the details on that. Okay, and let's look at some of the pros and cons of a corporation. The biggie is up top, and that is limited liability. And that is a large portion of the reason why corporations exist, is to limit liability. The second big reason is they can do an IPO, initial public offering, and raise significant amounts of capital by issuing stock. How easy is it to transfer ownership? Well, it takes about 10 seconds. You can transfer your stocks to somebody else really instantaneously. What happened to Apple when Steve Jobs died? Well, nothing. It's got perpetual life, so it went on. Specialized management. There are downsides. The biggie, because I encouraged you a minute ago, if you're forming a corporation to get a lawyer involved, that's got to indicate that it's pretty complicated. It is complicated. There's a lot of ongoing reporting, paperwork. Another biggie is double taxation. So the challenge of, let's say, a C Corp is they're taxed at the corporate level, then they pay dividends, and then that's taxed again. So that can be problematic. With an open corporation, there's also a lot of reporting, so there's a lack of secrecy. So those may be considered downsides of the traditional corporate form or a C Corp. So let's take a look at the advantages and disadvantages of sole proprietorships, partnerships, and corporations. And with corporations, I'm referring to the C Corp, the traditional corporation. So I'd invite you to take a look at the slide. I think it's a fantastic summary of some of the pros and cons of each.